And so, yeah, I started with a small account.
Yeah,
and
$5,000.
$5,000, yeah. And, I just started selling a couple naked strangles in a $5,000 account, a couple stocks. And I'm like, this is easy. Of course. I can't believe I found this. Like, it was more challenging to be able to be successful implementing these strategies with a smaller account, like a Tasty Bite account. And, I had 90,000 and I went in with the account and I said, I'm going to do this.
I'm about to break down the interview that you just saw and explain exactly the strategy that he used to turn $5,000 into $130,000. And if it was a fluke or if it can be repeated. Also, if you stay tuned, after I break down the strategy and show you step by step how to use it, I'm also going to share where this strategy can fail and how you can prevent that from happening so that you don't have a failure with this strategy. All right, let's dive into it. This interview was from a Tasty Live Rising Star interview, which is where they take traders who have a promising strategy and performance and they showcase what they've done. Now, again, in most of these videos, Tom, the interviewer, talks way too much and we don't get as much of the strategy as we would like. So I'm taking my over 5 years of options trading experience and taking what these people said and breaking it down to a step-by-step strategy so you can see what they did. So let's dive into this one. Okay, this dude's main strategy is called short strangles. If you have no idea what a short strangle is, I will explain it to you in plain and simple English. A short strangle is simply predicting or betting that a stock will stay between two levels. So let's say we have a stock that's trading like this. You're betting the stock will stay below this level and above this level. If you're right, you make money. If not, you lose money. That's how simple the strategy is. So that's all he's doing. And he's mainly doing it on what? You need to know what he's trading on. He's trading on futures options. So futures options mainly would be something like ES. Why ES? Because it's super popular, it's liquid, it's tradable, and it's the S&P 500 futures. So this is what he trades. Around 60 to 70% of his trades come from the ES futures. He also trades the rest in random currencies, and he also trades commodities and stuff like that. So that's what he's trading, the strategy he's trading, and those are what he's trading it on. Now let's talk about the specific rules that he... All right, when you put on a short strangle, which is an option strategy, what you do is you need to select a few things. You need to select levels, aka what level is the stock going to stay below, what levels is the stock going to stay above, and what is my expiration date? How long in the future do I think this trade should be structured? And let's walk through those levels. Number 1, days until expiration, also shortened as DTE. And our days until expiration, what happens is he goes out and does a typical Tasty mechanic style, which is 45 days out. So again, with 45 days out, that means he takes the current date, he adds 45 days, and whatever the nearest expiration date is, that's the one that he goes into for that options chain and looks in more detail. This specific trader likes to have a higher credit collected. That means when he puts this trade on, he likes to make a lot of money. And what I mean by that is he targets a 20 to 30 delta. What does this tell you? This tells you how far out this trader is going. So for instance, when the stock's trading at a certain level, let's say in this example, the stock's trading here, a 30 delta would be close to the stock price, a 20 delta would be down here, and a 10 delta would be down here. So the further away from the stock you are, the lower your delta is because it's less likely the stock will reach that level. However, the closer you are to the stock price, the more credit you can collect. Why? Because options are insurance. The higher likelihood that the stock will hit will hit that level, the more money it will pay out. So he likes to stay around this level here where he's close to the stock price, but not too close, but also not super far out where you can be super safe. There's around a 20 to 30 delta in a normal environment. However, in a lower volatility environment, what does he do? He trades 30 to 40 delta in low vol. So that is actually really, really close. A 40 delta is like right up here near the stock price. So why is he doing this in a low vol environment? For the sake of this video, we don't know what he personally defines as a low volatility market, but we do know in general if the VIX is below 20, that's a low volatile market. Now again, it can vary for each stock, but let's just say when VIX is below 20, he likes to use a 30 to 40 delta. And so that means he's really coming close to that stock price. Now he does that because in low volatility, it's hard to collect as much money. However, like we mentioned before, the closer you go to the stock price, the more money you collect. So he likes to collect more. So when the volatility is lower, a 20 to 30 delta would be giving him less money. So he moves it up closer to the strike price or to the stock price to collect more money. Okay, so now we know how he enters trades. How does he exit? What's his stop loss rules? What is he doing here to turn $5,000 into $130,000? Well, his stop loss rule is very simple. His stop loss does not exist. Okay, he does not use stop loss. Instead, he likes to manage his positions and look at what's going on, what's happening in the market. How do I want to adjust? This is really weird and can have a lot of downside because short strangles do not have defined risk. They have unlimited risk if you don't trade it correctly. So without a stop loss, he has the chance to lose out on a lot of money. But I must say his case is special, as he did mention in the interview that, guess what? He spends all his time watching the market. So if you're someone who can't do that, this strategy may not be for you, or you may want to put in some stop loss rules. But again, because he watches the market 24/7, he doesn't have to put in hard stops. That's what he does. Now let's talk about delta exposure. So that's a delta sign, hopefully, and exposure. So when we're talking about delta exposure, what he does is he likes to stay delta neutral. If not, he actually stays a little bit of a short delta, because we all know that's synthetically long. So that means in general, he's going long the market, and the market's more bullish than not. So of course, you're going to make money with this approach. But it also depends on when you're trading this. So now let's get into the specifics here. Is this actually possible for you today? Can you use this strategy? Let me answer this in two ways. Number one, is it possible to turn $5,000 into $130,000 using this strategy? Yes, but it will take a ton of years. It will take a lot of time. The specifics here is what he did is he started with $5,000, traded a short strangle, and blew up his account. Again, this is like I was mentioning. If you don't have a stop loss, you're going to blow up your account. So what he did is he went to work, he saved up $90,000, then used the $90,000 to turn it into $130,000. So he really only made a 50% return. That's all he did, and he lost $5,000 when he blew up his account originally. Was I giving you clickbait saying 5,000 to 130,000? Honestly, maybe, probably, yes, I did. But I'm just using it because Tasty Live used it, and that's what their interview said. And so I wanted to just use it from the interview. But anyways, so he did not turn 5,000 to $130,000 using the strategy. However, this is a profitable strategy. You can use it. I would say add some stop loss rules, like a 200% or 100% stop loss rule, and you'll do a lot better. However, you have to understand that he's really close with his deltas, and he doesn't have a stop. So that's where this can go wrong. If you're trading a highly volatile stock with a lot of news, it can easily break this way or easily break down. What this is resulting in max loss types of scenarios. We do not want those max loss scenarios. So how do you prevent this from happening? How do you trade this better? Well, number one, have a stop loss. 100 to 200% should work. And also stick to a 20 to 30 delta. Or if the market is in a low volatile period, don't trade, or guess what? Just stay at the same level, because the more you move up, the higher of a likelihood that a one-time event will affect you and it'll turn into a loss. Anyways, guys, this is my review of the interview to give you step-by-step what the strategy is instead of hearing Tom talk forever. So I hope this was more beneficial to you. If you enjoyed it, let me know in the comments, and I'll do more videos just like that, because I know when I watch those videos, they're encouraging, but Tom talks forever and I just want to hear the guy talk. Anyways, guys, see you in the next video.